Good morning, everyone, and welcome to our 2022 investor presentation. I'm Paul Bendall, CEO of the management company of First Mortgage Trust. Before I start, I must emphasise that I'm not providing financial advice. My presentation today will give you factual information only. My main goal today, though, is to convey a picture of a company that knows what its core business and strengths are, undertakes that business with care and confidence, and is performing to a very high standard. As a business, there are two things we focus on: risk and return, or put another way, resilience and performance. This has been at the heart of what we do for over 26 years now. It is ingrained in our DNA and is reflected in our purpose and values as a company. What do we mean by resilience and performance? It is derived from what you, our investors, have told us, that the security of your investment is equally as important as the return that we provide. You would have noticed in recent newsletters we talk about optimising return as opposed to maximising it. This means balancing risk and return, or bringing resilience and performance to life. As I said, it's ingrained in our DNA and it's central to our decision-making framework. When making a decision, the first question we always ask ourselves is this in the best interest of the investors? And if the answer isn't an emphatic yes, we move on. It's been that way for 26 years now and it won't be changing. I'm very proud to say that despite the economic headwinds we've encountered over the course of 2022, First Mortgage Trust has never been in better shape. And it's a real credit to our highly skilled team and our unwavering focus on sticking to what we know and living our purpose and values. We are an active manager, and the importance of this has never been more prevalent. We continue to be able to proudly say that in 26 years we have never lost a cent of investor capital, and there are very few businesses in our industry that can say the same thing. So where are we today? The fund size now stands at $1.55 billion. Our loan book is close to $1.37 billion. We now have 54 people located in offices in Tauranga, Auckland, Wellington and Christchurch. Tauranga remains our head office with the bulk of the team still located here. We now have over 6,000 investors. And today our loan book is secured by over 1,350 first mortgages located primarily in the key New Zealand markets of Auckland, Waikato, Bay of Plenty, Wellington and Christchurch. The headline numbers are impressive, but it's the numbers that sit behind this that bring our resilience and performance to life. The average loan-to-value ratio across our entire loan book is now less than 50%. Now, the average for the last 5 years has been 50%, which highlights our consistency in assessing risk. Our front book LVR, loan-to-value ratio, is 48%. What we mean by this is the loans that we've originated over the last 12 months are at a lower LVR than our overall portfolio. And this is us just assessing where we see the market at the moment and taking risk off the table. Our lending ratios are significantly lower than those permitted under our governing documents. The average loan size is $1.8 million. The average loan term is 16 months, and the portfolio is well diversified both geographically and by asset type. We have very low loan arrears, highlighting the quality of the lending that we do. And finally, we don't lend to first home buyers. In addition to our very sound risk position, the fund has delivered consistent returns, and we're very pleased with delivering 5.59% given the quality of our loan book. We've received a lot of positive feedback since announcing the latest return. This included a text message which I received from investors which read, "Hi Paul, what a nice surprise to receive our latest dividend of 5.59%. Congratulations to you and the team. Love, Mum and Dad." Now, my parents are also investors, but their feedback, whilst possibly not the most objective of feedback, is typical of what we receive, but it's fair to say not every investor signs off their communications to me love from. On the investor side of our business, over the last 12 months, investor funds have grown by a net $266 million. This means that we have received a gross $460 million and redeemed $194 million. So to break this down, over the last 12 months, we have onboarded close to 1,000 new investors, with over 6,800 subsequent deposits made. We have also processed over 3,700 investment redemptions. The numbers are very impressive and a real credit to our dedicated team. In tough economic conditions, this really highlights the confidence and support you, our investors, have in us and what we deliver for you. We are very proud of the fact too that over the last 2 years, 80% of our new investors have been through word of mouth. And once someone invests with us, 80% of those people will make a subsequent deposit. A business only consistently achieves these kinds of results from having a clear understanding of what its purpose and values are and having an unwavering focus on bringing them to life. As a team, we recently revisited our purpose and values to make sure that they were still fit for purpose. We looked at who our customers are, what we do for them, as well as the communities that we live and work in. That money that you trust us with helps New Zealanders achieve their property investment goals. It builds houses for people to live in, and it helps shape our communities. In return, we're able to provide a stable return to you, our investors, to help you achieve your investment goals. We put customers at the heart of our business, developing and maintaining long-standing relationships that are built on trust. It's also important for us as a business to be part of the communities that we live and operate in, and we are proud to partner with many local organisations and charities and help make a difference through these sponsorships. We are very mindful of our obligations as a good corporate citizen, and all of this will be captured in the work we are doing around ESG, or environmental, social and governance policies. This is becoming increasingly important to investors, and we are in the process of developing our ESG framework. We have a strong team culture that encourages the development and well-being of our employees. Boiled down to one sentence, our purpose as a business is about creating a better future for New Zealand. Our purpose has to be brought to life, and we do this through our values, which are teamwork, integrity and achievement. Teamwork, we care, connect and collaborate. This means respecting and valuing each other and delivering on our commitments. Integrity, we do the right thing. This means taking responsibility, always doing the right thing and using sound judgment. And achievement, we get it done. This means we empower our people to deliver results, and we recognise and celebrate our achievements. These are very important to us, and as I've already said, we live by these, and this is reflected in our results. So turning now to who manages First Mortgage Trust. First Mortgage Trust is managed by First Mortgage Managers Limited, which is a licensed manager under the Financial Markets Conduct Act. We are regulated by the Financial Markets Authority. A key feature of our structure are our supervisors, trustee executives for the Group Investment Fund, and Susan and Karen are here today, so welcome, and public trusts from the PI Fund. They play an integral role in the governance of First Mortgage Trust and have the right of veto on all of our lending decisions. This sets us apart in the market and provides another layer of comfort for our investors. I'm pleased to say that we have a very effective working relationship with both of our supervisors, who comment on the quality of the management of First Mortgage Trust. We are an active manager, which means that we decide which loans to invest in, we make sure the loans comply with the Trust's investment guidelines and policies, and we manage these loans on behalf of you. A key part of being an active manager is making lending decisions based on our skills and knowledge as a specialist property lender, and includes us assessing market conditions and continuously monitoring the market, using the skill and experience of the team to identify and structure the best possible lending opportunities, and managing these loans through to successful completion. The board also plays a very active role in the governance of First Mortgage Trust. A subcommittee of the board is the Loans Committee, which meets monthly to review our lending performance and discuss our lending appetite. There's a saying that lending money is the easy bit, it's getting it back that takes a skill, and that's what we really focus on. The other facet of determining an active manager is to outperform its chosen index. In our Statement of Investment Policy and Objectives, or SIPO, this is exceeding the bank 12-month term deposit rate by 1%. Over a long period of time, we have consistently exceeded this metric. As a manager, we also continue to invest very heavily into the business. Our biggest and most important investment are our people. It is their knowledge, skill and experience that drives our results. Over the last 2 years, we have revisited our team structure to make sure that we have the right people in the right roles to ensure that we can deliver the best possible results for our investors. We've expanded the team, but more importantly, we've created new roles, especially in the senior leadership team, and filled these roles with highly experienced and talented people. These roles include a head of credit, a head of lending, a head of compliance and quality assurance, a head of people and culture, a head of marketing, and the promotion of Roger Ford from Financial Controller to Chief Financial Officer. In addition to the structure, we focus very heavily on training and development. We make sure that our wider team are kept up to date on current legislation and best practice ways of doing things, but most importantly, that the knowledge and experience that we have within the business is shared right across the team. A big part of our goal as an employer is to develop and promote our staff. People are much more engaged if they see career progression, and for us enjoy continuity with people who know our business, but most importantly, people who know our culture. We don't just talk about this, we do it. In the last year or so, we have had over 10 internal promotions, including 4 into the senior leadership team. To give this context, that's about 20% of our team. We have also just been recognised externally for our work in this area, having just been announced as one of the winners of the top mortgage employers for 2022. This award recognises mortgage industry employers and looks at what makes an organisation one of the best in the industry. To be recognised, you need a staff satisfaction rating of over 80%. It is very pleasing to receive this award, and even more pleasing that First Mortgage Trust was only one of 3 companies to receive this award 2 years running. We also invest very heavily into cybersecurity. Local company Delta Technology Solutions provides a comprehensive security framework, meaning that our systems are monitored 24/7 by both state-of-the-art technology and Delta's cybersecurity team. They are constantly auditing our entire system, even down to our mobile phones, meaning that they can respond to any threats immediately. We are currently developing our online portal for our investors. We know that this is important to you, but this portal is being developed in conjunction with the cybersecurity protection. So turning now to the lending opportunities. We know an important question for you is who do we lend to, where do we lend, and where do we see the opportunities? Firstly, the non-bank sector in New Zealand is continuing to grow, and we are seeing a structural shift in the funding landscape in New Zealand, which is in line with international trends. This has been driven by several factors. Banks are losing the personal touch. Banks are increasingly focusing on debt servicing at the expense of other key factors like the history of the person that they're lending to or the underlying value of the security of the loan. Don't get me wrong, debt servicing is very important, and we also focus on this, but successful lending is about considering a number of factors, and the banks seem to be losing this. Capital requirements are increasingly making real estate lending difficult and more expensive for the banks, and basically, if the computer says no, they don't seem to be interested anymore. A question that we get asked often is, do you lend to the people that the banks won't lend to? And in part, the answer is yes, but the banks should be lending to these people. Many of them are business owners with strong asset positions who want to invest into their business. Many are over 50 who on the bank models can't demonstrate how they can repay a loan from their primary income source by the time they're 65, despite having a very strong asset position and diverse income sources. And some people are just fed up with dealing with the banks and are prepared to pay a bit extra for the service that we provide. We estimate that the non-bank lending market makes up about 5% of the market that First Mortgage Trust operates in. To give this context, in Australia it's 27% and growing, and places like America and Britain are 40 to 50%. The Reserve Bank of New Zealand has recently published mortgage lending statistics for the New Zealand market. The graph on the screen shows the non-bank lending over the last 4 years versus bank lending. As you can see, the non-bank sector has significantly outstripped the banking sector. Since 2019, bank mortgage lending has grown 25%, non-bank sector has grown 152%. First Mortgage Trust has enjoyed a period of very good growth over the last few years, but as you can see on the next slide, the next graph, mortgage lending in the non-bank sector has been at a significantly higher rate than First Mortgage Trust's growth. And if you refer back to the graph that Michael showed earlier that went like that, when you compare our growth to the market, we're much flatter. And this highlights our strategy to carefully manage our growth and to cherry pick the very best lending opportunities. Given the growth that we have experienced in New Zealand and the trends evidenced overseas, if the New Zealand non-bank market even gets to a share, so non-bank market share even gets to be half of that of Australia, the potential market growth is enormous. So where does First Mortgage Trust want to operate? We want to position ourselves as a viable alternative to the banks and a better option than other non-bank lenders. We aim to be slightly more expensive than the banks, but cheaper than other non-bank lenders. This, combined with a focus on delivery of solutions, will enable us to cherry pick the very best lending opportunities. This is how we optimise your return rather than maximise it. We balance the risk. All of this combined leads us to believe that there are strong future lending opportunities in our key markets and across the diverse range of asset types that we lend to. So we've covered who we lend to and where do we want to position ourselves in the market. So we'll now look at where do we lend and to what asset types. We have a very diversified loan book across a number of measures. By geography, you can see from the graphs we have 60% of our loans in Auckland, 11% in Canterbury, 10% in Wellington, 6% in the Bay of Plenty and 5% in Waikato. This means that we have a combined 92% of our loan book located in New Zealand's 5 main centres. And there's a reason for this, that we focus almost entirely on these markets, as historically they've performed well from a property value perspective. because they are regions that have growth, employment opportunities and strong GDP. By virtue of our size, we now have lending experts based in these key markets aside from Waikato, which is serviced from Tauranga. Having our team located in the same areas means that we can actively manage our loans. It's not just about lending money. Successful property lending requires highly active management, and having experts close to our security properties enhances that proposition. So looking at now at our lending by asset type, we don't just focus on geographical diversification when considering the spread of our loans. We also consider different types of assets to lend against. As you can see from the graph, 61% of the fund is secured by loans to residential properties, 21% commercial, 5% rural, with the rest of the fund secured by cash and term deposits. Our percentage of rural lending has continued to decrease over time, and we now originate very little loans in this space. And that's very intentional, as we don't feel we have the in-house expertise to assess this type of lending. As I mentioned earlier, our success has been generated from sticking to what we know and what we are good at. We assess the portfolio to an even more granular level and monitor how much of our lending is an investment, development, or on land. At any given time, our development exposures generally range between 20% to 25% of our lending, and currently we are closer to 20%. Land is similar and generally ranges between 15% to 20%, and we are currently closer to 15%. Looking now at our lending limits, our SIPO dictates the maximum limits we're able to lend on different asset classes. The industry regards these as conservative limits, and rightly so. As you can see from the chart, very few of our loans come close to these thresholds. We are cautious. Under the SIPO, First Mortgage Trust will only lend to a maximum loan-to-value ratio of 75% on residential property, 66.7% on commercial property, and 60% on rural. And as you can see from the table, we are well below our maximums across all of our asset classes. In fact, over 99% of our lending is less than a 70% LVR, and 70% of our lending is less than a 60% LVR. This provides a substantial buffer to market movements, and also means that our borrowers have to have significant equity in the transaction before we will lend to them. The quality of our loan book is reflected in our loan arrears and non-performing loan statistics. Over the last 5 years, our loan arrears have averaged 0.9% of the fund, and as at 30 September 2022, they were 0.76% of the fund. This is an impressive result in any environment, but even more so given the economic conditions. We have no new non-performing loans, which again speaks to the quality of our loan origination, which is driven by our highly skilled team. Our largest loan is only 1.8% of the fund versus a permitted maximum of 5%, and our top 6 lending exposures equate to only 16% of the fund versus a permitted maximum of 25%. We also have no related party lending, meaning that we do not allow directors or staff to take out loans with First Mortgage Trust. This policy has been in place for 26 years now and won't be changing. So as you can see, the portfolio is well spread across all the key metrics that we monitor. Our success has also been driven by being very selective in the loans that we want to write. I mentioned earlier we like to cherry pick the best loans. We get to see a lot of loans come across our desk, but on average we only lend on 1 in 10 applications that comes across our desk. So we say no to 9 out of 10 of the loans that we see. As I said, we like to cherry pick and be conservative. Looking now to the market conditions. As an active manager, we closely monitor economic data and how this may impact on the New Zealand property market. On the negative side, we are paying close attention to the geopolitical tensions, the cost of living increases and how this is impacting on inflation and how that will impact on consumer spending. Interest rates having increased by over 3.5% in the last 10 months, migration outflows and the labour and resource shortages that we're experiencing. On the positive side, the New Zealand dollar is undervalued, which helps our export industry. There is an international food shortage and we are a food producer. We're beginning to see the return of foreign tourists and international students. And finally, the tight labour market means that unemployment is expected to stay low in comparison to other economic cycles. So the impact of this is that the housing market in New Zealand has fallen on average by about 12% so far. Respected economist Tony Alexander believes that the market will continue to weaken for a little while yet, but that we may be reaching the end game of the cycle, but cautions against an expectation of rising prices at this point. We remain cautious in our approach to both our lending and liquidity management, and this is evidenced by the loans we have originated in the last 12 months being at a lower LVR than our 5-year trend. From a liquidity management perspective, we are holding cash reserves well above our required minimum levels. Both of these leaves us well placed to take advantage of the market opportunities that the change in cycle will present. So turning now to our investment returns. As stated in our SIPO, our investment objective is to exceed the average bank 12-month term deposit rate by at least 1%. Over the last 5 years, we have comfortably exceeded this, highlighting the stability in our returns. Based on our 30 September return, this premium was 1.6%. In the last year, we have distributed $76 million to our investors. This equates to a return for the past 12 months of 5.43% after the manager's fee, but before tax. It's also important to note that the costs of managing the fund are borne entirely by the manager, save for the supervisor's fees and a reserve fund contribution. These costs include all staff, premises, technology, marketing, compliance, and cybersecurity costs. We don't charge performance fees, and a couple of years ago, First Mortgage managers made the voluntary decision to share a portion of the loan fees with you, our investors. The management fee has remained at 1.5% for 26 years now. This is a highly competitive fee. It has never been adjusted for inflation, despite costs rising significantly, particularly over the last year or so. So looking to the future, we look ahead with confidence. The non-bank lending sector in New Zealand is growing, and we are in a strong position to take advantage of that growth. By design, our investment policy suits relatively conservative investors, those seeking regular income or those choosing to reinvest their income to increase their investment over time. The nature of the trust structure and investments provides security for capital protection. We're not driven by high returns. As I've said earlier, we seek to optimise the return, balancing risk as opposed to maximising return. We take a relatively conservative approach in the way we manage the fund. We also balance liquidity. We have a minimum liquidity level of 5% of the fund. This is the minimum cash that we need to hold. Liquidity is currently closer to 12%, meaning that we have over $180 million of cash or term deposits with a mix of New Zealand banks. Depending on lending opportunities, liquidity does move around. However, we have a target range of maintaining liquidity at around 10% to 15%. As I mentioned earlier, we're also investing in technology, and we're working on an investor portal. This is something we know that's important to our investors, and we want to make sure that we provide both a great and secure solution. So in closing, the fund is clearly in a strong financial position and has performed exceptionally well in a challenging environment. The fund is now over $1.5 billion, which means we now have even greater access to the best lending opportunities across all the key markets that we target. We have over 26 years of continuous success behind us. There is invaluable knowledge built up within the business. The fund continues to grow, and we, the manager, continue to invest very heavily into the business. Your money is secured by First Mortgages at relatively conservative ratios. In addition, the fund holds significant cash reserves invested with New Zealand banks. And most importantly, our commitment to you. We will strive to do the best for all of our customers at all times. We will always fully comply with all relevant legislative requirements. We will always act in the best interest of our investors. We have been resolute in keeping to our conservative operational policy, and we have maintained our commitment to steady, careful, and well-managed growth. Our results speak for themselves and have done so since our inception 26 years ago. No investor has ever lost capital with us. A highly competitive interest rate has been consistently paid to investors every quarter. So once again, I would like to thank you for your continued support. We're glad to be helping you achieve your individual financial goals, and we appreciate your attendance here today. So I now welcome any questions. So we've never had a breach. We are like every financial institution, in fact, like every business in New Zealand. So the question was, have we had, what is our cybersecurity policy? Have we had any breaches? And how many attacks are we getting? And what do we do to minimise those attacks? So the answer is, firstly, we haven't had any breaches. Like every business in New Zealand, but certainly financial institutions, we're constantly being attacked. But the system that Delta are running is both a combination of artificial intelligence and human resources, so they're constantly monitoring those attacks and adjusting for that. Delta, in partnership with companies like IBM, for example, So it's an international approach that comes to this, because obviously most of the tax are coming from offshore. In terms of the system that they're running, they have the ability to isolate all of our devices right down to our mobile phone. So my phone here, if it got hacked, they could actually isolate my phone immediately and keep the rest of the system running and restore the system back to a pre-hack level straight away. So it's as foolproof a system as we can possibly get.
One of our trusted advisors has just informed us that he's called on First Mortgage Trust because of an apparent movement into property development. Can you comment on that?
Yes, we have increased our property development. As I mentioned, it makes up about 20 to 25% of what we do. And it just depends on the market conditions. So property development is a very good lending opportunity for us, so long as it's done well and resourced properly, and that's what we've done. About sort of March 2021, we felt that the development market in Auckland particularly was getting particularly hot, so we actually pulled back from that market, and that's why we're operating at the lower end of our range. So when the market conditions we felt were more favourable, we did a little bit more, and in the last 18 months we've actually been pulling back from that market. But it's not to say we're not going to keep doing it, because there are very good opportunities that exist in that market.
Yeah, just a little bit on ESG. Can you explain what the impact that is on whom and what you can invest in?
So we're in the early stages of our ESG response, and it's broken into three areas. So the environmental piece, which is probably the piece that's going to have the greatest impact, so that the fund itself, the trust, actually has zero carbon emissions. It's the manager that is the carbon emitter, and part of the work that we have to look into is how we actually manage or monitoring the carbon emissions from the people that we lend to. So it's quite a big bit of work. We know the banks are doing a lot of work around that at the moment, but that is something that we will have to report on going forward. In terms of the impact at the moment, we don't know what that impact will be.